Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, and today's guest is a returning guest, Robert Wenzel. He's the editor of the Economic Policy Journal. Robert, Happy New Year. Thank you for joining us.
Same to you, Mo.
For today's podcast, Bob, in December and January of every year, I usually do a review and an outlook with all my guests. So for this podcast, like I've done for the past couple of podcasts, I want to talk about what happened in 2015 and talk about what might happen in 2016 going forward. Now, one of the major events that happened in 2015 or late 2015 is that the Federal Reserve raised their interest rate, even though it was only a little bit, 25 basis points. Were you surprised that they did that?
No, not really. As a matter of fact, I was forecasting that they would do that. And if you look, there's actually a rate that they control directly through market trading called the federal funds rate, and they had moved the federal funds rate up to 12 basis points from a low of 6 basis points earlier in the year. So it did not surprise me at all that they're going to move it higher. They also said in their statements regularly that if unemployment hit 5%, they would raise rates as long as they thought that inflation was going to kick up, and they continue to believe that. They now hold the very unusual view. From my perspective, it's an unusual view that 2% inflation is good for the economy. So there you go.
Yeah, and the Fed president in your neighborhood in San Francisco think that they could raise the rate about 5 times this year. Do you believe that, or do you think they could maybe reverse the rate? Because there's a lot of people, especially within the Austrian economic school, think that eventually they're going to reverse the rate once we have maybe a stock market crash or something happen.
Yeah. Well, I'll tell you, I think those Austrians that think there's going to be a reversal here are confused. I'm not ruling it out completely. You know, there is a lot of volatility in the stock market and economy overall, but we don't seem to be in the part of the business cycle where you're going to see that kind of crash in the economy. I really don't understand where they're getting that perspective from. I mean, to me, it seems almost now like they hold the view that the Fed will never, ever raise interest rates, and they can't ever raise interest rates. And my perspective has been inflation is coming back. As inflation climbs, that's going to give them room to raise interest rates. For example, if inflation jumps back to 5%, and remember, inflation has been going down mostly because of, or the inflation index, I should say, the price inflation indexes have been relatively low because the price of oil has crashed. And I've got something called the EPJ Daily Alert that I send out to investors on a daily basis. And in that, I pointed out that all you need is the oil price to eventually stabilize, and it will somewhere, even if it's 10 cents. I don't expect it to go to 10 cents, but it will stabilize. And once it's stabilized, what you're going to get is you're going to get a situation where the other prices that are going up are going to have a bigger impact on the indexes without the dampening of the oil price. And you're going to first you'll get it up to 3% and then 5%. And when inflation is at 5%, the Fed is going to have no trouble raising interest rates to 2 or 3% because really a natural market where a Fed wouldn't be intervening, you would have interest rates that are higher than inflation rates. So people who think there's going to be some kind of crash in interest rates or reversal and that interest rates can never go up, I don't understand that. Now, I want to add that it doesn't necessarily mean we couldn't have something going on short term that might push the Fed funds rate down and the Fed may lower rates, but I don't think it's a major possibility. As far as 4 or 5 rates, I think it's very difficult to tell at this point how many rate hikes there might come in 2016. But that's the way the Fed seems to be thinking. And there's 2 important points here with regard to the people that are thinking that. First, as you mentioned, that it was the Williams, who's the Fed president here in San Francisco. And what's important to know about him is not that he's a leader in the thinking with regard to the Federal Reserve and directing or providing leadership to other Fed members, but prior to his becoming president of the Federal Reserve in San Francisco, Janet Yellen was the president. So he took her position, he was her aide, and they still talk, and generally, publicly, he takes her line. So when he says he's expecting 4 or 5 hikes in interest rates, he's indicating, as far as I'm concerned, what Janet Yellen is thinking, the Fed chair. Now, today, the Fed vice chair, Stanley Fischer, who I consider a very, very important key figure here in Federal Reserve policy, also went out and said that those on Wall Street who think there are probably only going to be 2 interest rate hikes in 2016 are underestimating how many hikes there should be, how many hikes could possibly happen. He says their expectations are too low as far as the number of hikes. So as long as we don't have a major crash, and I mean, you can have, the world is very volatile right now. The structure of the United States economy and the global economy is very shaky. China's in a lot of trouble. So it doesn't mean things can't go wrong quickly, but you don't have the specifics of a bear phase of the boom-bust cycle. You're not in the bust cycle right now. You're in the boom cycle, and I consider it the boom cycle because the Federal Reserve is printing quite a bit of money, and it's showing in the data. Unemployment is very low. I mean, they'll come out, the perma bears will come out and say, well, there's a lot of people that are no longer in the employment market, and the numbers have shown that these are retired people. So, yeah, they're not in the market, but people who are looking for jobs are finding them. Auto sales are at new highs. They were record highs for 2015. You have a return of a strength in the housing market. Housing prices are going up regularly. That's not a sign of a downtrending economy. So there's sort of a mentality. It comes out of the hate the Fed movement, and there's all kinds of problems with the Fed, and it should be ended. But that doesn't mean that the Fed can't do anything, and that they won't raise interest rates from time to time. I expect them to do that.
No, the argument that's been made for why the Federal Reserve can't raise interest rates is mainly because the effect it will have on the amount of debt that the U.S. government owes. So any increase in interest rates would result in billions and billions of dollars that the government have to pay in interest payment. So that's one of the arguments that a lot of people will make, and that's why they don't believe the Federal Reserve can raise the interest rate. Another thing is a lot of people out there are saying that the Federal Reserve and U.S. government need a weaker dollar to enhance the export market, so to stimulate the economy as well. So there's a lot of argument out there on why a lot of people don't think this hike is going to last for a long time.
Yeah, there's a number of problems with that view. The first problem is that I'm talking about interest rates going up because the inflation rate goes up. If the inflation rate goes up, it's going to make that debt a lot cheaper to pay off in terms of real dollars. Or what that means is the government will generate more in taxes in terms of real dollars. I should say nominal dollars. They'll get more dollars in, and they'll be able to pay off the debt cheaper. So what's being looked at is a very, very narrow perspective here. And the perspective is, hey, interest rates are going to go up, the Treasury is going to have to raise more in debt, and the Fed won't allow that to happen. Well, not only will interest rates go up, but the Treasury is going to generate more dollars because of the inflation. But secondly, the Fed has to fight inflation even if interest rates are going up. That's a given. They're not going to allow inflation to go to 10% or 15% because it's going to raise interest rates. That's not going to happen. The people who are saying, hey, interest rates are going to go up, therefore the Fed is not going to raise rates, they're looking at just one specific item without the big picture. And the big picture tells you they have other things to be concerned about. The interest rate problem is a problem, but it's not as big as people think, in the sense that because it's going to be causing an inflation, you're going to have more money coming into the Treasury to pay the debt. But the big thing is, when you get that inflation, the Fed is going to have to fight that at some point. Whether it's 6%, 7%, 10%, they're not going to say, wow, this is going to mean the Treasury is going to have to raise more money and we can't allow that, and therefore we're going to go to Zimbabwe rates. That's not going to happen.
And it's not like the Austrian people in the Austrian school doesn't want the interest rate to go up. They all want it to go up. They want it to be a lot higher than it is right now. I just think they think the Federal Reserve reasoning for doing it is it's not aligned with what
they just, from my perspective, they're just looking at one sliver of the bigger picture. But secondly, the Austrian position, or a free market position, I should say, is you let the market determine where the interest rate should be, higher, lower. It doesn't matter. Just you get the Fed out of the manipulation of the interest rate. So the free market person should really be silent, in one sense, on the interest rate, and just say, hey, the Fed shouldn't be involved in this. It looks like they've probably got it lower than where it would be without their intervention, but we're not saying the Fed should somehow go in there and control it and take it higher and sit at some level. What the free market advocate would want is the Fed to get out of the way and just allow interest rates to be set by market conditions.
Well, we already had an interesting week in the first week of or the first week of the year 2016. The China stock market crashed overnight, just like it did in the summer of 2015. A lot of the stock market had crashed between 7 and 8% overnight, which resulted in the U.S. stock market also going down a lot as well. So, in result, the Chinese government has done what a lot of government have done for the past decade: print more money and try to prop up the stock market. Now, the Chinese government has printed about $20 billion in effort to try to revive the stock market, and they've done that as well in the summer, along with other regulation, other stuff that they did to try to get it back up. And now, I want to ask you, what they're doing right now with the $20 billion bailout, so to speak, is this the end game, so to speak, for central planning economic, or other people call it Keynesian economics?
Yeah, well, not really. I mean, the China is really in a lot of trouble, and I've been bearish on China for quite a while. What you've got here is the same old thing. Inflation a year ago or so in China was heating up dramatically, and that's why they slowed their money growth and raised interest rates. And what they're trying to do is sort of allow these mini crashes to occur, and then they pump some money in to slow it down. So it's sort of a back and forth in China. And but there's plenty of Keynesians around, and they'll just write off what's going on in China and come up with some kind of explanation for it. There's nothing to do with the money supply manipulations that are actually causing it. But it's a mess in China, and it will probably get much worse.
Yeah, and the China economy is shifting toward becoming a manufacturing country to also becoming a consuming country, just like the U.S. And also we're seeing the wages in China increase double-digit year after year in result of inflation and wanting higher wages, and also the standard of living over there has increased. And so it's not surprising to see that their stock market has bust, so to speak, because it's been booming for the past decade or
Yeah,
so.
yeah, Mo. It's a boom itself. There's nothing inherent in the boom that requires a bust to follow. The only time that occurs is when you have the government intervention in there, specifically through the central bank, pumping in money and propping it all up. Now, there's a lot of bad investment in China, a lot of investment that would never have occurred without the Chinese government intervening and the central bank pumping in money. So that's where the crash comes in, because at some point the inflation gets severe enough that they even if they wanted to continue, they just fear destroying the currency. So that's what happens, and that's what you're seeing now. You're starting to see a great weakness in the Chinese currency, and you're seeing these continual drops, and then the China Central Bank and other agencies will take small steps to prop it up short term. But there's a much more severe problem in China. But there's nothing in a boom itself, if it's a legitimate boom, that would cause it to crash. It's only because they're manipulated booms by the governments, by the central banks that cause the booms, a distorted boom that ultimately turn into bust because they have to stop what they're doing at some point because they fear the inflation. And that's what will happen in the United States eventually. I mean, we've been through a period where they've pumped a lot of money, but there's been a lot of fear in the economy, and that money hasn't been spent as rapidly as it normally will be. But over time, that'll work out, and that's where you're going to get the price inflation here in the United States, and then the Federal Reserve is going to have the same kind of problems as China does.
One of the other major event that happened in 2015 is actually the 2016 presidential election, and all the candidates that been coming up, just as Donald Trump, Hillary Clinton, and Bernie Sanders. Now, Bernie Sanders is a self-proclaimed socialist, but I mean, pretty much all the candidates are socialists if you think about it. But this guy has becoming more and more popular, and gained a lot of momentum, mainly because he speaks out against Wall Street and all the big corporation, and he wants to, increase regulation on them and break up the big banks and et cetera, and then, also raise the minimum wage for everybody, make it $15 so everybody can have a comfortable earning and be able to support themselves and et cetera. Are you surprised by his popularity going up, considering all the things that happened in 2015, like a lot of movement regarding raising minimum wage?
Well, it's not surprising in the sense that most of the people in the United States don't have a clue as far as basic economics and how the economy works and what should be done and what shouldn't be done. And socialism is always tempting. It's dangerous. It doesn't work. It should be thrown in the trash heap. But what you have is a situation where these populist demagogues come out and say, I'm going to do this and I'm going to do this and I can control this and all that. And they just want to get in and be the new dictator to replace the old dictator. I mean, that's what it comes down to. So it doesn't surprise me. I mean, there's always these populist movements. Sanders is one, and then you've got Trump being the other. I mean, he's just doing it for a different crowd, but it's sort of the same sense. People are tired of what's going on. They don't understand what will really fix things, and so they follow these guys that'll take us down the merry road to more regulation and intervention and oppression.
Now, the final segment of this podcast, I want to talk about 2016 and get your outlook. Now, you don't have to throw out prediction in terms of numbers or like how far up Jones going to go or stuff like that. I just want to get your outlook in general on what you think is going to happen in the economy in 2016. Do you expect to see more of the same from what happened in 2015?
Well, not exactly. I mean, I think where we're going to see the most significant difference is in price inflation. I've been on the price inflation bandwagon for a while now, but as I mentioned, there's been a lot of money that's been pumped into the economy, and we have a situation where there has not been the type of price inflation you would normally see with this kind of money, and that's because there's been a strong demand to hold cash balances. But at some point that will change. And when that changes, you're going to see a tremendous spike in inflation that I just don't think most people anticipate. So that's the big thing. And because of that, you'll also see a rise in market interest rates, and that'll sort of drag the Fed along, allowing for the fact that there could be some kind of small thing in the short-term period that would reverse Fed things. But I think that's a slim possibility. We're headed higher for inflation. We're headed higher for interest rates. Those are the two major things people should be aware of for 2016.
Now we've had asset inflation for the past, I'll say, since 2008. I mean, if you look at the stock market, we've had inflation in that. You mentioned the housing market. For the most part, in the United States, has recovered, and we're seeing inflation in that sector as well. So there's been inflation, but a lot of people, when the government started to print a lot of money, we're expecting, Zimbabwe, where the money becomes worthless, and you start seeing, billion-dollar bills being thrown out there.
Right. And you're going to see a pretty dramatic acceleration of the consumer price inflation. That's the focus where the Fed and most people is right now, as far as when they say there's very little inflation. And that's the number that's going to turn around. As far as the asset inflation, you're absolutely correct. I mean, that's been very, very strong. And according to Austrian theory, that's where you would expect it, in the capital goods sector. And then slowly it moves into the consumer sector. But the consumer has been cautious in husbanding their money, and when that turns, you're going to see a dramatic turn that's going to surprise most people as far as how quickly inflation accelerates. And it's going to surprise the Fed too. And then all that stuff about the Treasury, they're concerned about raising interest rates, that's going to go out the window.
Yeah, and for the people on Main Street, they're struggling paying the bills. If you look at the housing market, the price of housing going up, even rent is going up year after year. And if you look at the holiday shopping numbers for all the major retail stores, a lot of them reported negative sales for the holidays. So it tells you that the discretionary income has not been where the government and the central bank wanted it, like pre-2008 financial crisis.
Yeah, I think the money's there. I mean, if money is printed, it's sitting in a cash account somewhere. It's just a case where it hasn't been spent. If the money is totaled up and on the M2 reports of the Federal Reserve, the money supply numbers, it's out there and it's been expanding, and it's just the case that people are being careful with their wallets and not spending the money as aggressively as they were in previous periods, and that'll turn as the memory of the 2008 financial crisis moves farther away, and your unemployment is good, and people have jobs and all that kind of stuff, and the stock market stays relatively strong. You'll see that money come out.
Robert, I would like to thank you for your time. And people want to find out more about what you do and your work. Where can they go?
Sure, the best place is to go right to economicpolicyjournal.com. That's my main website where I talk and write about the economy all day, every day. I also publish a website called Target Liberty, and there are links to that from Economic Policy Journal. And then I also have a newsletter that goes out to investors, businessmen, economists. I even have some government economists that subscribe to it. And you can find out more about that if you go to economicpolicyjournal.com. So that's the key. Go there, and you'll be able to see the other things I'm doing, and any books that are coming up or books that I have out, and all that sort of stuff.
Okay, great, Robert. Well, thank you for your time, and come back on again soon.
Sure. Alrighty. My pleasure. Thanks, Mo. Take care. Great question.